Okay, so once again, I welcome you, and we are going to start our corporate finance course. And the topic number one, which we shall discuss today together, is the introduction of corporate finance. It's a very lighter topic, so I guess you won't be requiring so much of, I will not make you do a very strenuous intellectual exercise. So when you talk about the corporate finance, I always see that there are three main strands of corporate finance. The entire discipline of corporate finance is based on three major pillars. The first one is what long-term investments should the business entity must undertake. And the second one is that where will the business entity get the long-term financing to pay for its investments? Because without investments, the company, you can't sustain, you can't grow. So even if you want to have your zero rate of growth, you still have to invest to keep at the zero level, lest you should become negative. And the third point is that how will the business entity manage its everyday financial activities, such as collection from customers and paying the suppliers? So these are the three main things which are underlying the spirit of corporate finance. Of course, I would be discussing the detailed answers to these three fundamental questions, but if I have to give you very quick answers, then my answer to the first question is the capital budgeting. Okay, so the first question is, I repeat, what long-term investment should the business entity must undertake? And the answer is that capital budgeting field is the key answer to the long-term investments. And what is capital budgeting? Capital budgeting is a systematic, iterative process of planning and managing firms' long-term investment. And the long-term investment, this is very tricky. This inclusion of time dimension in the field of finance. What is long-term? What is short-term? I remember when I was studying economics at the bachelor level, and then we have so many time periods, like market period, what is called very short period. And then you have the short period, and you have the medium period, medium term. Then we have the long period, and then we have awfully long period called secular period. But I think in finance, things are far more hand-on. And here we have clearly a very simple kind of cutoff point when it comes to the time dimension, and that is short period and the long period. The convention, not a rule, but the convention or the practice is that anything which is below 365 days is considered short period in finance. So 364 days is the cap. Whereas in the long period, anything which is 365 and above could be, decades. Okay, so we have a simple rule of thumb, cutoff point between the in the different time periods, which are only two, long and short, is a year, 1 year. So those investments which would be maturing for 365 days and above. So those investments whose benefits are expected to exceed for long period, for a year or more. That is the capital budgeting. So this is involving the process of planning and managing, and there is so many tools and techniques within the domain of capital budgeting, that how we take a project and how we reject a project based on certain well-defined logic the numerical examples. As a finance manager, when you'll be working as a finance manager in a company, you'll find that there are so many potential projects which you can undertake. Okay. But do you have money to finance all of them? Well, no. So there is an opportunity cost when you take up a project. You take one and you are refusing other. And second, how do we filter out the junk? Sorry for my. How do we filter out the projects which are not plausible, which the company must not take? And then we apply the different capital budgeting technique, and then we find out that, hey, if we are having 100 possible projects available to us, out of them, these 30 projects must not be taken. Straight away, we knock them out. And the question is that, now 70 projects are left. Will you undertake all of them? The first reason is that no, because you don't have so much of money. And secondly, you don't even have so much need to undertake all the projects. So out of all the eligible projects, remember, we had 100 in the beginning, 30 straight away, excluded because we applied those capital budgeting techniques, and they say that these 30 projects are the firm value eroding projects. They are causing the company negative value. So those straight away we filter out. Then even of the remaining 70, we apply the techniques, and we have some pecking order that, hey, this project would be taken up, but not that one. So we choose between them. Okay. So as a corporate finance manager, you will be having the problem of choice. It's easy to reject the projects, but it's far more difficult to choose which one to take and which one not to take, even though both of them seem pretty much promising. Okay. And for this, we apply different techniques. I will not discuss today because it's very, but to answer your first question, that is, what long-term investment should the business entity must undertake, we shall be heavily depending on the capital budgeting topic. Then comes the second question. And the second question is, where will the business entity get the long-term financing to pay for its investment? Okay. For this, we will be discussing this topic of capital structure. Okay. Capital structure is very close to my heart. Most of my ongoing research, or in the recent past, is about capital structure. Okay. And the capital structure is about the choice between debt and equity. Okay. So this choice of having debt over equity or having equity over debt, this conflict, this ongoing issue between debt and equity, how much the firm should be leveraged, that discussion we shall be having in the capital structure or the financial structure. There are many hybrid variants of capital structure, but still, if I apply a very Puritan approach, then debt and equity are always the two major sources of firm financing. Capital structure is also called basically firm financing. Firm financing means where money comes from. Where money comes from. If I have to define a firm, I would say that a firm is a trifurcation, or a firm rests on three pillars. The first one is where money comes from, financing. capital structure? Well, the money comes from debt and equity. And where do you see debt and equity? You see in the balance sheet. In the balance sheet, I hope those people who come from the accounting background, you know that we have a balance sheet equation which says that the assets are equal to liabilities plus shareholders' equity. This liabilities plus shareholders' equity, they are basically underpinning the firm financing. Okay, now money has come. What would you do with them? Well, you invest. Money goes to. So if you have to define what is financing, financing is money comes from. And what is investment? Where money goes to. Where does money go to? Well, the money goes to invest in different projects. Where do you see them? You see them on the asset side of the balance sheet. Now, when you have the liability side, money comes from, then you have the asset side, the money goes to. Where is the income statement in this whole discussion? Well, the income statement is that the return on investment, the return on your assets must be more than the cost of equity. So if your firm financing, if all your financing cost is 6%, including debt and equity, everything, then on the asset side, what you expect is minimum is 6% and above. So if, for example, if your cost of financing or the cost of capital is 6%, but your return on investment is 5%, then it means that you are in a deficit of 1%. And where this deficit, you see, it comes from the falling profits or the rising losses in the income statement. It means that the link between the firm's investing and the firm's financing is the firm's operations. And where do you see the operational performance of the company? You see the operating profit. And where it is in the income statement. So the capital structure is basically a linkage between the money comes from and the money goes to. Like financing, like investing. If your firm financing is risky, at high risk premium, is too much of short-term financing, you have borrowed at huge amount of interest and the conditions, so many debt covenants, then that would impede your freedom to make investment. Okay, so that's why I often use this phrase that like financing, like investing. For a corporate finance manager, it's very important, and rather it's very challenging. It's a daunting task for a corporate finance manager to fix the optimum capital structure. The capital structure is never static. It's a very dynamic concept because the need in the market keeps changing. Sometimes you want to induct more debt and you want to retire the equity. But in the process of doing so, you may invite more risk to the firm. And to minimize this risk, you may opt for less debt and comparatively more equity. So therefore, this tug of war between debt and equity is very much ongoing. It always keeps going, and I don't know when it will end, I don't see. So you look for you maintaining a balance between debt and equity on perpetual basis. And the second point about the capital structure is that you always look for that combination of debt and equity and the hybrid sources which are having the least cost. So you always look for the minimum weighted average cost of capital. And in this course, we shall discuss, we spend pretty considerable time on the calculation of weighted average cost of capital. And third is that you need to be, you need to look at the supply side, that can you have the access to the reliable sources of financing, if in the normal situation, and also if there's any contingency, can you raise additional financing to the company? Okay, so therefore, this long-term financing, and why I use the word long-term financing, because this capital structure is not about paying salaries to your staff, but it's more to do with those assets which are going to serve the company for a long period. So therefore, these are not just operational expenses, but these are the investments which are likely to fetch services to the company for the long time. So the capital structure is answering to your second question, that where does money come from? And the third question is that how will the business entity manage its everyday financial? Because every day is very important. Sometimes we think too much long, but we forget that, hey, what is the situation between 9 to 5? Do you have enough liquidity to pay your utility bill? Do you today is the deadline to pay the supplier? Do you have enough money to pay? What if your check bounces? Okay, your customers who promised to pay you last week hasn't paid yet. What are you doing to expedite the cash inflows? So these things are also important. Remember that if you are not able to manage your short-term financing, then there can be the liquidity crisis. And if this liquidity crisis keeps accumulating, then eventually it can pose the company a solvency crisis also. So the long-term financing problem do not arise suddenly. Many times the long-term financing problems, they arise because the company is not able to manage its cash inflow and cash outflows. My teacher, when I was studying this program in finance in Scotland many years ago, my teacher used to say, he was a guru in quantitative corporate finance, and he would always give the example that in FTSE 100, not FTSE 100, FTSE all, the index that we use in Britain for all the companies, he would always say that in London Stock Exchange, every year, as a rule of thumb, 1% of the companies get bust. And those 1% companies which get bust, which become bankrupt, 75% of them have very handsome looking profits. And the major reason they flop is that their treasury management is awful. Treasury management means where that money come from, cash flows, cash inflows, cash outflows. So one reason is that it's not that the company will not get the cash flow, but the timing of the cash inflow and the cash outflow is so bad that despite having good profits, good revenue, the companies can become bankrupt. So this third part is very important, that if you are not paying attention to your day-to-day financing, then it will have a knock-on impact on your long-term solvency as well. So these are the three major, and yeah, we call it working capital management, basically. So these are the three important pillars of corporate finance, which I would always, while I'm giving you these lessons, I would be very much sticking to these three ethos of corporate finance. The second point which I want to discuss with this in this introductory topic is that the role and the positioning of the financial markets and some corporates in the process of financing. Now, I think before I explain this slide, it's good that we move on to this one. So this is a kind of the movement of funds. Now you can see here that a company can issue its securities. If you look at point A, so the firm issues the securities. And when the firm is issuing the securities, which again are in broadly speaking in the form of debt and equity, then that is where the money comes from. And then you are investing those financial resources in the assets, which could be your current assets and non-current assets. Then the C is that now because you have those assets, so you are making operations based on those assets, and those assets are expected to generate the cash flows. And then from that cash flow, which finally you don't hold all the cash at your disposal, you are distributing to the government as a part of tax, and you're also distributing the part of your profits to the other stakeholders. And here when I see this particular diagram, this particular rectangle, I remember the macroeconomic phenomenon, that how the national income is distributed. So a company in a way, in many cases, is a miniature form of a nation. Okay, so this basically have the same network of cash flow. And not all the cash flows are shared among the stakeholders of the company. Stakeholders mean it could be, you pay employees, you pay them salaries, you have taken the land, or you pay the rent, you have the capital, you pay the interest, and finally you have the profits which are left for the shareholders. But not all the not all the profits, not all of them are distributed to the shareholders. A part of them is paid in the form of taxes. In fact, taxes are paid before. And then the net profit that you have, you keep a portion of it as a undistributed profit, which you can use it for the future reinvestment. So basically, it's your homegrown savings. It's the company's internal saving, which it can use for further investment. And then F is that part which is the cash is paid out to the investors in the form of interest and dividends. And because you have the two major categories of investors, the debt holders and the equity shareholders, so you pay them interest and dividend respectively. So this is how this network of financing can appear in the picture. But each of these arrows, these angles, these diagrams, these rectangles, we shall discuss more in detail as we move on. Then also we have two broad categories of financial markets. These are the primary market and the secondary market, but first we'll discuss the primary markets. In the primary market, the firm is selling its financial claims. And those claims, again, are of two types. They are the debt and the equity. And that claim is basically used to raise the finances, the money. Let's put it straight away. When the company is engaging in the primary market, it could raise the finances through the public offering when the general public is invited to invest. It's like a general public offer, or what we call as an IPO in case, or the firm and the financiers, they can have their own private negotiations, and you can bypass the public at large to get those funding. Okay, so the company can have these two types of the financing through the primary market. Primary is in which the companies itself in per se involved. A public offering is involving selling of the securities to the general public. So it's like whenever we see that a firm is willing to invite public at large to invest in its debt and equity, most likely equity, because in many countries the debt is still not traded in the stock exchanges. So I know in some countries the debt is also trading, but a sizable part of the world, especially the developing countries, the debt is still not a trading instrument there. Using equity, the public money, public at large to invest in your financial claim. So you have to have certain kind of registration. You are followed by a regulator. You must take some permission from the concerned regulators. I named some of them. For example, SEC, Securities and Exchange Commission, in the US is probably the most powerful regulator in the world. We have the Financial Conduct Authority, FCA, in the UK. In Finland, we have the Financial Supervisory Authority. So unless your company is registered with these apex bodies, you cannot raise funding in an organized market. The registration requires many things, but mostly it's about the substantial disclosure, and it also costs. So there is a cost of registration, especially the underwriters, because the underwriters are the institutions who will be buying your financial claims if nobody else comes in the picture. So obviously, if they are taking so much of risk, they have to be rewarded as well. Partly to avoid the regulatory requirements and the expenses of public offering, the debt and equity can be sold privately, whereby you are having a very one-to-one negotiation with the bank. I think that in the European markets, this is more prevalent. So this kind of private placement is more prevalent in those countries or in those corporate settings where the ownership is thick. In other words, where you have small number of large investors. And this is a very European phenomenon, that here you have the small investors, few number, but they are very big. Like if you look at the Finnish companies' share ownership, you will find some big players. There are some shareholders who are holding 30%, 40%, or even more shares. Whereas it's not possible to see such substantial thickness of ownership in the US companies. So when the ownership is thick, is more condensed, when you have small number of large shareholders, in that case, the private placements are more seen. But if you are having another extreme, very Anglo-Saxon kind of approach, that where you have the ownership structure, where you have the large number of small shareholders, where the highest ownership, you can be owning 2 to 3% of the stocks of the company, and you can be the largest shareholder of the firm. So in these kind of situations, when the share ownership is very thin, not thick, but thin, in such situations, it's not so common to have the private placements. Okay, but anyway, whether you are following the you are approaching the public at large, or you are approaching the private placement. For the companies, I won't say that if you make the private placement, you are totally avoiding the regulatory requirements. Of course, you are avoiding some of the regulatory requirements which are more common when you are approaching the public at large. But it'd be wrong to say that there is no regulatory requirement for the private placements at all. There are. Okay? But comparatively, in the private placements, these regulatory stipulations, requirements, formalities are lesser when compared with the public offering. Okay, and then we have the secondary market. After the financial claims are issued in the primary market, then those can be traded in the secondary market. So now the firm itself is out of the picture. Okay, so for example, if I want to buy the stocks of a company, the one option is that, let's say Finnair. Finnair is launching an IPO, and I subscribe to Finnair. I get them. Now here I buy the shares from the primary market. But if I want to sell them, I will not go to Finnair. I will not email CFO of Finnair that, hey, I want to sell my stocks to you. Then I have to go and sell them in Helsinki Stock Exchange or wherever the firm is listed. So then the secondary market comes in the picture. And I'm not going to buy all the time. It's not even possible to buy the stocks from the company straight away. So when you are buying and selling the stocks or any other financial asset in the secondary market from some broker, from some agent, then you are basically talking about the secondary market. So here, the company who is the actual initial issuer of the security is out of the picture. Something similar, the two more terms I want to discuss with you. When it comes to secondary market, then these two people or these two institutions within the institution are very important in the secondary markets, the dealer and these auction market. The dealer are those people who buy and sell the securities for themselves at their own risk. So they basically buy the shares or any other financial asset, and then the individual investor can buy from them further. Okay. Whereas, so I give an example, it's like a car dealer. That a car dealer is buying car from the company and then selling to the customers. On the other hand, rather the most common used path is the broker and the agent. In fact, as individual investor, I would rather, I may not have contact with the broker, but the agent is the person who I would be interacting much. And they are the people, they are having less risk because they are not buying and selling on their own, but they are rather taking the commission when a transaction is conducted. Of course, it's possible that some financial institution, some investment company could be doing the dealership and the brokerage together. But if we split their functions, then the broker is not having that much risk as the dealers have. The broker is only a commission agent. Okay, at the large scale, there can be many agents working for a broker. So mostly, if you are an individual investor, you would rather be contacting the agent more often than a broker. And here I find a similar example that it's like a real estate agent. They don't normally buy the houses. they're only taking the commission because they are the go-between. They are bringing the buyer and seller together, and they just take the commission. Whereas a dealer is investing in the asset per se. Okay, so these are the two important players in the secondary market. But before we go to the source of financing, the next topic within this this introductory corporate finance, I want to ask you if you have any comments or any questions. Is the sources of financing, okay? As we discussed already, that the financing is needed when you want to start a business or you want to expand it. Or if you want to expand it, are you going to expand it in the same field or do you want to diversify? You started your business as a toy manufacturing company and now you want to diversify in the leather sector. Or you started as a paper mill and now you're planning to open some financial consultancy firm. So you not only need to, so the expansion doesn't have to be in your original line of operation, but you can also diversify to the other lines as well. The financing of firms depend on several factors, and very important of them is that the nature of the firm. Okay, not all the firms have same amount of or the similar need for financing. If you are an oil company, then the quantum and the nature of your financing would be very much different from the situation when you are a grocery store firm type. Do you need the financing for the short period? Is the nature of your business is that you have to innovate very often? So you are spending massive amount of money on R&D or innovation. So the type of investment which Apple or Microsoft is doing is not same as if you are a coal mining company. The size. Are you a big size company? Are you a small firm? If you're a startup, so the size of the company, the legacy of the company also makes a big difference. And the capital requirements. Why are you needing the capital? Are you going to make some kind of small change in your information system? Are you replacing? So if you're a university, are you going to replace one form of the learning platform? You're not happy with that, you want to replace it with a new one, or you are going to construct a altogether new building? Or are you going to open a new campus in some different city? So then the amount of capital requirement as such will be so different. And then what stage of business you are. So are you in the startup stage? Are you now going to you want to expand, or you're already a very mature company, but you are only in the confines of your national boundaries? Do you want to go abroad? Do you want to open a full-fledged subsidiary abroad? Or is it going to be some kind of joint venture? Or you want to have some affiliate company? So depending upon what type of business expansion you are looking forward to, accordingly, you're financing not only the amount, but the nature of financing, the sources of financing would also change. As I said a few times today, that there are many new innovations in the firm financing, but traditionally speaking, the debt and equity are the two main sources of financing. Okay, so that's like some of the curtain raiser of this discussion about it. The first source of financing that we shall discuss now is the equity financing. Equity financing is the investors are giving money to the firm, and in exchange, the firm is giving the ownership right to the investors in the business. And when you are owning the firm, then you have a claim on the firm's profits. So, and this claim on the firm's profit commensurates with the amount of or the value of investment you have in the firm. Equity involves a permanent investment. It doesn't, I wrote the circumstances when it can happen. Then when the firm is dissolved, that's a different thing. But in the normal course of time, the equity is a permanent investment, but the equity holders can change. And where do these equity holders change? Well, they change in the secondary market. You buy the stocks, you sell. I buy the stock. Let's say an example that if I buy stock of Finnair via an IPO, then I sell the stock to some agent working in Helsinki Stock Exchange, and then the same share which I sold can be bought by some Mr. B, and then the same process, it goes to Mr. C, D, E, whatever. It can change multiple hands. Okay, but the equity as such remains a permanent investment, and it doesn't disappear unless there are some emergency situation, there are some exceptional situation in the company, when the company is maybe requesting the Ministry of Corporate Affairs that, hey, we want to reduce our authorized capital, or they become bankrupt, or there's a need to dissolve the company altogether. Okay, so that's why I wrote this expression that the ownership remains permanent, but the owners may change. An equity stake in a firm can be in the form of membership. So when you are buying those stocks, so depending upon how many stocks you own, you have the ownership rights. Once again, the ownership often come in conflict with the control. Ownership gives you the right, and the right of ownership can also have an impact on the control of the company. I want to give you an example. If you buy the equity shares, the common equity, the common stock, then you are entitled to the company's distributed profits, and the amount of profit which you get from the company, which is in proportion to the number of stocks you have, the dividend. But that ownership also gives you one more right, and that right is that you can control the company as well. And how you can, it doesn't mean that you go and you start running the company by yourself. No, neither you have time, nor resources, nor capacity. Okay, this control comes through your voting power, that you can vote. So in the voting, you can change. It could be possible that the owners, the share owners, they are voting in such a way that they can replace the entire board of directors. But some investors, they are not really interested in the control of the company, and they say that, hey, we don't want to vote. So in that case, we can create a hybrid form of equity, which is called preferred stocks, which basically means that they are like equity, but they don't have the voting rights. Then the question is that If they don't want the voting rights, what do you give them to make compensation? Because after all, they are surrendering a right to vote. So what you give them is that when you are distributing the profits, they would be given preference over the common equity owners. So if there's a queue of investors standing, the shareholders standing, then those who have the preferred stock would be first in the queue. So in the pecking order, they would be standing in front of the common equity owners. Okay. So remember that not every equity owner is interested in impacting company's control aspect. Depending upon the profile of the shareholders, depending upon the utility function of the share owner, the company can create the different classes of stocks. So some people, they want more ownership thing, they want more control part. The others, they are just interested in the ownership and they want to get the profits and that's it. Okay, so there is, depending upon that. So the common stockholders may, and remember that it has to be clarified now that just because you are common stockholder, it doesn't automatically give you the right to the dividends. You don't have the right to dividends. The company is giving you dividend, it's a different thing. It's possible that the company doesn't give you dividend at all. So it could be possible, but whereas in the preferred case, a predetermined dividend is always determined that, hey, these are the preferred stockholders and they would be getting some X percentage of dividend. And this thing is premeditated. But in case of common equity, they may get dividend or they may not get. It could be possible that all the dividend, all the profit which is meant for the shareholders is absorbed in giving to the preferred stockholders. It could be possible that the company is having losses and there's no dividend in the first place. It could also be possible that everything is good, nothing wrong, the company's profits are increasing, or rather increasing quite a lot. And the company want to reinvest those profits back in the business. And it could be possible that the company is even offering the investor, the shareholder, that, hey, do you want dividend? And the investor said, no, not at all. Don't dare asking me this thing. Does it sound cynical that the company is offering dividend to the company, is offering dividend to the shareholders, and the shareholders say, no, I don't want dividend. It's like asking you that, hey, do you want salary? And you say, no, don't give me salary. If you're my employee and I ask you, would you like to have salary for the month of January? And you say, no, not at all, Shab, don't even ask me to give salary. Then the second form of financing is the savings. And here I'm not considering the big company. It could be a startup company or some small scale company. So many times the company is borrowing against its, for example, its life insurance policies and also its real estate equity. So you have a life insurance policy and you are borrowing money against those the cash value of the policy. Okay, many small companies they often do it that they have some insurance policy. But remember that here the insurance policy is that policy. Not I won't call even the insurance policy, but they are more like assurance policy. Assurance means that when you get the money, even if the event has not happened. Like look at the situation of the life insurance. In case of life insurance, a person insures his or her life, let's say for next 20 years. Okay. Now, if the person dies between these 20 years, then the kin of the deceased would be getting the compensation. But even if the person doesn't die. Okay? And now 20 years have matured. The person who is the main the insured person is still alive, would get the amount which has been issued anyway. But in case of fire insurance, in case of accident insurance, in case of theft insurance, you only get the claim if the incident has happened. Of course, if the incident has not happened, it means you have a clean record, you can get some extra credit. For example, if you take the car insurance and the accident has not happened for the last few years, then you can get the rebate from the premium, for sure. But you can't say that the full value of the insured amount would be refunded to you because the accident has not happened. Okay, so those insurance policies which are less like insurance but more like assurance. Assurance means that regardless of the occurrence of event, the insured person would get the money at the end of the insured period. It's more like a saving. It's more like a bank deposit in many senses. So here, that life insurance policy can be used to borrow money. Okay, the same way you can do against the real estate. If you have a mortgage, I gave an example here that if your house is worth $150,000 and you have taken a mortgage of $60,000, it means that you have the $90,000 of surplus value. And if you want to take a credit, if you want to take a loan from the bank, then this 90,000 is the is the amount against which you can borrow. So it could be possible that you have some personal savings, and then you can have some variants of saving, like life insurance or the real estate equity loans, and then that can be used to borrow the money. But of course, these are very limited sources of funding. If you're a big company, then these are just peanuts. These are very small channels to get the funding. But of course, when you're a startup, if you're a small company, then you might be looking inwards that what type of internal resources you can generate to get the funding. And the next one is the venture capital. But before I discuss it, I want you to read this slide and find out some key points, and that we can discuss very quickly. So in case of venture capital, first of all, the venture capital is coming from the firms or the individuals who are investing in the young, privately held companies. The young private companies, they might have they're very idea-oriented enterprises. But the problem is that the ideas can be great, but maybe the pockets are empty. So in this case, the venture capital can fill this void. So those great ideas, they don't die away just because they don't have the funds. So there are some specialized organizations and even the individuals who you can call as a venture capitalist. Once again, the capital is given. The finances are provided in exchange of the ownership rights. The venture capitalist, they do not generally provide funding to the company unless they have some proven track record. So for example, if you are a manager, if you used to work as a manager of a company and during your tenure, you have done a great job. So there is something good in your CV and now you are you don't work with that company anymore. And you want to start up your own startup. So in that case, you have something to vouch on, you have something in your CV. So even though it's a startup company, it has no history, but because the people who run this startup has a history, so then the track record of the management can be used as a proof. And then the venture capitalist can decide to fund such firm or not. Yeah. So the preference to the business is always given if you are having some nice narrative. I mean, you have a competitive advantage, and you can prove that you have the competitive advantage, and you have a strong probability to add value to the company, and you can produce some patent. You have some USP which is very unique, and also it can be protectable. So nobody can just copy your idea. I hope you might have seen some TV programs. I don't know whether they are real or they are some fake. But for example, Shark Tank or these kind of programs, when you are seeking some funding from some business pro, and they are really grilling you before they decide to invest in your firm. But of course, when they decide to invest, they are seeking certain percentage of ownership. And sometimes they can ask you for a huge amount of ownership. And not only that, they can also say that, hey, I would bring some people also in the startup. So not only that, I would be giving you money, and I would be needing the ownership, but I would also bring some people who would run your startup. But the problem is that even though the startup financing is very useful, can fill this gap, but the problem is that the venture capitalist can basically impede. They are impatient, because if you're a venture capitalist, you don't want to tie your fund for a long time with a startup, because there's always a risk that this startup can fail or somebody can copy the idea. So you are in a rush. You mean the venture capitalist is in a rush to recover his or her money back. So there is always a managerial short-termism. So they are short-termist. If the person who runs this startup want to convince the venture capitalist that, hey, could you have patience for next 5 years? Because in the next 5 years, our idea would really mature. Okay, then you really have to struggle to convince your venture capitalist that can he or she wait for 5 years, because they are impatient, they're more short-termist. And if you prepare them to be patient, then the problem is that they can be interfering too much, because they come from the corporate sector background. Okay, so they can overlook the idea, whereas your idea could be very creative, so you can be heavy. You might think like an artist, but these venture capitalists, they could be really putting so much of restrictions on you that, could you do this way, can you invest this thing this way, can you postpone this investment, can you do this, can you do that? So either they are very impatient, or they are really interventionist in the company's affairs. And even in the day-to-day affairs, they could be a lot of interference. Normally, they are investing in the firms which have the high growth potential. So that is all about the venture capitalist. We also have the angel investors. Now here the name angel is, and here the word is capitalist. So if you compare angel and capitalist, maybe the angel sounds more humane. The angel investors, they have some element of philanthropy in their mind. Of course, they are looking for the profits. They don't want to have the losses. But there is some element of philanthropy that they are really are in a kind of way to help the small businesses, or those those startup entrepreneurs. They are really They want to encourage people to invest, and in the process, even if they have to compromise the profitability, they are prepared for it. I know there are some rich private bodies who are providing funding to some R&D companies who are innovative, and they are prepared that it could be possible that there's nothing. This R&D project could be a flop show, but they are willing to take this risk. So the nature of their financing is comparatively less based on profitability criteria, but more based on the developmental criteria in which they want to do something good, development. However, it's not right to say that they don't care about the profitability. They do care about the profits as well. But if I have to compare between the venture capitalist and the angel investors, then they are a little bit more patient, and they can wait, and they are not so short-term profitability obsessed. So they can wait. And in many countries, in the developing countries, there are some public sector bodies which are working as angel investors. In many countries, there are some development banks which can give you loan, which can give you equity, and in turn, it's more how to say it. It's less conditional investment, and people are not seeking the share of profit right from the word go, but they are more patient. So in many countries, this kind of development finance is given by some public sector organizations if they don't find any private owners. But in many rich countries, in the OECD nations, you might find some private sector angel investors also. But even though they are less restrictive about profitability, to some extent, the element of problems that we discussed, the impatience and interference, which is coming from the venture capitalist, also exist in case of angel investors too, even though the degree of this shortcoming is not as big as what we discussed in case of the venture capitalist. And as I said, that in many countries, especially in the developing countries, there are some public sector development organizations which are doing this job of angel investors. And then, of course, we have the debt financing, which is, we all know that what is debt. The debt financing involves the borrowing of funds from the lenders. The lender can be a bank. It could be an individual. It could be some non-banking financial institution like insurance company, or it could be a corporate bodies. For example, in a hypothetical situation, let's say that Finnair is lending money to Nokia. Okay, so it can come from a corporate body as well. And the requirement, the stipulation is that you would be paying, you mean the borrower would be paying the borrowed money back, plus the interest thereon. And this is for the specified time period. Choosing the right type of lender and the right amount of loan is very vital, because it can have very serious impact. If you are choosing, here I use the word exotic, because sometimes you are borrowing, you mean the company can borrow from the unorganized institution, you know, some kind of loan sharks, and the amount of interest and the conditions that they impose can be so prohibitive that you are borrowing the money to make investment, to grow, but basically the company collapses before it's established, because the loan sharks, they are imposing so stringent conditions upon you that the company dies before it's born. The debt financing can be secured or unsecured. The security is by the collateral, because unless you give the collateral, you will not get the money. So the counterparty risk is less in this case, because if you are not able to pay the loan, then the bank can use the collateral which you have given to the bank as a, to otherwise to avoid the bad debts. The unsecured debt is also possible, which is without collateral. But the problem is that the organized financial institutions would not like to give you the unsecured debt. So for this, you may look for some non-institutional or unorganized institutions who do not impose the condition of collateral. So for example, some private investment houses which can give you the debt. But the problem is that because you're not giving them any collateral, they might impose the condition of the very huge default premium. So you could have taken the loan from a bank with collateral at 2%, but without collateral from some private lender, you are borrowing at 10%, 15%, or even more. Debt claims can be senior or junior. Now here I'm only talking about the institutional, the organized debt. If I run the company and I borrow from bank X, and then then because in the order, that's my first loan, so that would be called my senior debt. But imagine that I want to borrow more. I want to have another installment of loan, another dose of loan. Either I approach the same bank or I approach a new bank. In both cases, I would get the fresh dose of debt if I compensate the bank for being the junior claimant. Because try to understand, I borrow 100,000 euro from Nordea, and the deal is that I would be paying 2% rate of interest to them. And I have given collateral to Nordea as well. But when I want to have another 100,000 euros requirement, and I go to the next bank, if I go to Danske and I say that I want, everything is fine, but they would be junior, because if in the event of insolvency, Nordea is the bank, even though the debt holders would be standing in front of in the pecking order, they would be in front of the equity shareholders. But within the intra debt holders, there would be seniority, and there would be some bank which would be junior in the claims. So the Danske would be willing to give me loan if I compensate Danske for being junior. So it could be possible that if I'm borrowing from Nordea at 2%, I have to pay 2.2% to Danske to get the loan, because they are junior in the pecking order. So there is always a seniority and this subordinate thing. Debt financing can be for the short period. It could be for the long period. You borrow for both short and the long period, and the repayment schedules could be varying. You can have the short-term debt to finance your current operational activities, to buy the raw material and pay salaries maybe. But the long-term debt could be to buy to make the research and development, to buy building, to buy equipment. If you're a transport company, you are buying some haulage. If you're an oil company, you are going to have a new oil rig, so on and so forth. Debt financing can be in the form of bills and the bonds. Again, the debt financing is for the short period and for the long period. If it is for the short period, then generally and here I'm talking about the bills, because the companies also borrow from the non-banking institutions, individuals or the body corporates. So if you are issuing debt for the short period, then you will be issuing a document called CP. We call it corporate papers or the commercial papers. And these are normally for the short period, bills. So we call them the bill. Okay. So the bills are representing the short-term debt. And what was the cutoff point for the the periodicity in terms of debt? 364 days. But if you want to get the debt for the long period, and you are issuing then you will not be issuing the CP or the commercial papers, then you will be issuing the corporate bonds. And the bonds could be anything between 365 days to 20 years, 30 years, depending upon, okay? So if the company is issuing debt for the short periods, then they are signified by the bills. And if they are issuing debt for the long period, then they are signified by the bonds. So the bills for the short period and the bonds for the long period. Debt may be having a secondary market, but as I mentioned, that there are not many countries in the world where debt is trading like stocks. So even in those developed stock exchanges, secondary markets, in the developed countries, the degree of development of debt market is not as comparable to the equity market. Okay, so I would say that the secondary market for the debt is still in the process. Okay? It's not fully established yet. And then, of course, you can borrow from your friends, relative, and whatnot, but that's something very limited. If it's okay if you are a startup or a small scale company, but if you are a big company, if you are a listed company, then I think then the dependence on the friends, relative, and these kind of more like informal sources of loan funding are very limited. Okay, but of course, if you are a small company, if you are even a medium scale company, if you are a startup, if you are a company only at the idea stage, then these kind of informal channels of funding could be used. But as the size of the company becomes bigger, then the percentage of this form of financing is getting very, very limited. Okay, so these are some of the sources of financing. So this topic which we discussed today was kind of very easy start of the course.